Good evening, my friends all across the world. We're looking at the Symbotic Quarter 4 2025 earnings report. They just reported it about 30 minutes ago, and I've already been going through it. I've looked at the key points, in my opinion, and I'm going to go over with you guys, and then we're going to listen to the call together and just continue to check out this stock and what we think about it. If anyone's invested in it, make sure you guys drop a comment down below. I'd love to hear your guys' thoughts on the call as well as the company in itself, all that good stuff. So let's get right into it here. All right. So one of the main things I want to point out that I've seen with this earnings report is the strong revenue growth. For 2025, Symbotic revenue reported of 2.22 million, up 26% year over year. If you guys don't know, this basically is a company that is doing AI inside of storage and hardware, like all the stuff like the factory. I've made a video on it before, but it's tough to explain in words. Let me try. Let's see. This is kind of the picture you got to see. You got to see these guys inside of a warehouse just working. And let's think AI taking it over and taking over warehouse logistics and all this stuff. So that's kind of what the company specializes in. And in Q4, we've seen the revenue was very strong. The revenue was 618 million, which is up from 565 million last year. And this growth is very important because we see the backlog is growing and this company is able to scale very effectively. The one problem it is facing currently is just having the capital intensive automation and robotics, which is meaningful because it signals that there's demand for these AI powered warehouses and logistics, which are obviously scaling very quickly. The main thing is, I just want to watch for more progression, and that's one thing we've seen with the margin and adjusted profitability, as we've seen by the earnings report. Um, Cheers for streaming this. Got 4 leaps on the dip. Congratulations, my friend. Those will do. I think those will do very well. I've talked about this stock many times before. I'm very bullish on it. I think it's one of the best stocks on the market, especially the AI in the future. And it's constantly creating good quarters. They have a good management team. Everything I've seen is good. The one thing I've been worried about is the Class D shares. But other than that, there's nothing really. I could explain that more in depth too if you guys want. But other than that, there's no real downsides with this stock, in my personal opinion. Not financial advice, of course. Let me know if the microphone's all right. I don't know. I haven't checked it yet. But so what I was talking about is the margin progression. While the company is still unprofitable on a GAAP basis for the full year, it reported an adjusted EBITDA of 147 million for the year this year. And this is very important because it indicates that they're improving their operational leverage. So they are growing quickly while beginning to scale sustainable profitability metrics such as the adjusted EBITDA in the business, which is crucial to watch as the company is growing into its next footings. And this is something for a company. I forget what the market cap is. Let me find the market cap here for you guys. Stock market cap. The market cap is only 31 billion. This is a company that is trading at about 15 times book value, and it's not bad. In my opinion, the PE is very strong, and it's in line with the rest of the AI market pretty much. 58 break even, already green. Oh yeah, I'd ride that into the moonlight. What's the delta on it and stuff, if you don't mind me asking, in the theta? But other than that, I want to talk about the call. So we see they have a very cash rich balance sheet. I have some notes here on the screen that I'm just going to be reading and kind of pointing to as we read the quarter results. So I see that they have a cash rich balance sheet and they're increasing liquidity quarter to quarter. So at the end of Q4, cash and cash equivalents rose by 467 million, subsequently to 1.2 billion. A strong cash position in a growth company gives the company a lot of flexibility to invest in scaling, handling development costs. I mean, it's hard to develop these different AI models, and of course, everyone's trying to do this. Amazon's trying to do this. Big companies are trying to get in on this because they know once this is fully packed in and done correctly, then the near term margins will continue to increase, and we can see this continue to pursue strategic expansion globally as well as still domestically. 86 Delta 27. Oh, that's those are actually a really good play, man. You did very well on those. I won't lie. Um, so as I was saying though, the company has some of the strongest cash balance sheets as any AI company I've looked at in the recent months, and it's something that I think is very important because as we're seeing, they announced it's adding its first healthcare customer. We see, where was it? Where is it? Right there. We added Medline, our first customer in healthcare vertical, and enter fiscal 2026 enthusiastic about our prospects to broaden um, opportunities with customers. And this is crucial because they announced it's adding this customer, which is entering a whole new vertical for the company. And entering new verticals broadens the market opportunity and reduces dependence, which solely on retail and warehouse management. So as automation demands grows, there's labor constraints, obviously, there's supply chain pressure, e-commerce growth. So this is a long-term tailwind that I think will cause the stock to continue to grow highly. Um, Premiums and selling performance, CC's 85 to 90. Premiums really good. Um, I have not been doing the options recently. I've been slacking on the options plays. I've been super busy, but I gotta tap in with you, Drip Calc, because it seems like you know what you're doing. Ronald, I made a video on RXRX today. I don't know if you saw it. Um, I think it's not a bad play, and I kind of updated what my thoughts were on the company today. But back to Symbiotic though, the positive guidance that we see for the first quarter of fiscal 2026 is another crucial thing I want to point out for you guys. It's they expect revenue of 610 million to 630 million, an adjusted EBITDA of 49 to 53 million. This guidance shows that management is has a lot of confidence in continuing growth and margin expansion, especially we've seen a pretty tough economy, and I think that this company really sits in a high growth space where it's expected to benefit from structural trends such as supply chain reengineering, e-commerce fulfillment, labor shortages, inflationary cost pressures, and the rising demand for efficiency and logistics. So this company will directly benefit from all of these things. And as long as they continue expanding, and as we've seen, it's very easy. We've seen with the 26% year over year increase and on the top line and improving adjusted profitability, the stock may begin to be priced more like a scale growth company rather than a speculative early stage business. So I think that the new vertical of healthcare in large cash balance gives them a lot of optionality on what they want to do in the future. They can deploy in adjacent markets, acquire technologies, invest in R&D. They could they could accelerate rollouts. They could do a lot of different things with this much of a place in the market. And the strong cash position gives them near term margin or like room to just not execute fully or raise capital concerns. So I think the company is in a really good upside case. And if deployments accelerate, backlog grows meaningfully, so new contracts in healthcare and other verticals materialize, then revenue growth could accelerate beyond 26%, and the adjusted EBITDA margins could expand even faster, which will obviously be bullish for the stock. So one of the main things I think is big contracts coming in this next year and large rollouts, especially in the healthcare, grocery, e-commerce, could be catalysts and create another path to large addressable market capture. So I believe, one second here. I believe that Symbotic is at a promising inflection point with the combination of strong 26% revenue growth, improving operational metrics with the adjusted EBITDA, robust cash, and venture into new verticals. It sets up for a scalable growth company rather than just an early stage setup. So let me see. What's the backlog? The backlog, I was just looking at it before I started the stream. I'm pretty sure it was something in the bill. It's like 22 billion. the backlog. It's something crazy like that. I'd have to. It might be somewhere here. No, there's. I can't even. I think it's very high though. That's why the market cap is like, it's pretty low if you compare the growth factor of this company, and it's really, they have so many orders. It's just about scaling it, and it's hard to scale when, I mean, AI is such a new thing. You know, everyone's just starting to get in on this type of stuff, and I think it's going to be crucial to watch how they continue to grow. I'm excited to listen to this earnings call, which is starting in just about 12 minutes now. So I'm excited for that. And obviously, we know for a company like this, which installs large automation and warehouse systems, these take a lot of time to build and deploy. So the backlog is one of the strongest indicators of how much demand exists in the market, how much future revenue is effectively guaranteed, and how predictable the company's growth will be over the next couple quarters. So as we see this high backlog, I think it shows that there's a strong future sales pipeline, and it continues to rise, which shows there's accelerating demand. So I think if obviously we see, if they sign a contract today, like let's say they sign a contract for 300 million, they add 300 million to the backlog. They won't recognize all that revenue immediately, which is why the revenue honestly could be way higher for a stock like this, and why the $62 share price is not even as high as I think it will go in the near future. So as they deliver the systems over the next couple months and years, they convert backlog into revenue. So backlog is basically like the waiting line for the future revenue, as we've seen here. So I think that this is a very strong quarter, and I think the numbers are pointing to a very a bullish time for the stock. And for automation and robotics companies, the backlog is obviously more important than last quarter's revenue, because deployments take time. Revenue can look lumpy on the spreadsheet, and backlogs show the true underlying demand for the product, which is very high. And so with this large and growing backlog, we could see predictable multi-year revenue, strong demand from big customers. We obviously have the partnerships with companies like Walmart. We have scalability and operating leverage, and a lot of different things that I think are very bullish that haven't been mentioned by many people in the market. So let me turn this on here. If that's too loud, let me know. Let me hear the music. No, it's actually not the worst music. I'll turn it down though, a little. So yeah, the call is gonna start here in about 10 minutes. So I just got it up here just so I don't miss it. I'll be going over. I have the presentation up as well, so I'll follow them along in the presentation as they go, and I'll be giving my thoughts on the stock. So I'd love to hear you guys' thoughts though. Whatever you guys think. I think the numbers were very strong in general, and that's kind of my main takeaways from this. Let me give one more thing. This music's pretty good though, I'm not even gonna lie. So yeah, as you were asking, what's the backlog? I think the backlog, with it being this high in the billions and growing, this is basically the biggest bullish driver for the stock. And it's basically 10 years of revenue that's already locked in at the current run rate. So this backlog gives Symbotic high revenue visibility, strong pricing power, and a guaranteed deployment runway, which is golden basically for a company like this, as it shows there's long-term demand across multiple industries. And as they continue to expand into different industries, I think it will be crucial to watch the stock and how it grows, because they could really do anything with this type of technology, and once it's built up, it will really control a lot of the market share. So I think it's something to watch. And with the revenue up on the top line, even in a high rate tight spending environment, they're scaling very fast, which shows that there's a lot of demand, and retailers need automation. I think if you go to any retailer, the number one thing they'll talk about is needing automation, and this is the leading provider for it, and they're a company that we can directly invest in on the market, which is why I've been making my choices kind of over the last couple months, and I'll continue to make my choices as such, because I do see the bullish narrative for the stock, and I think that there's a lot of potential here, and I'm excited to watch in the next coming months what comes with this stock, but especially with this, where was it? The adjusted EBITDA of 147 million. That's a big deal because companies, robotics companies, usually stay unprofitable for years, and this suggests that their scale is starting to kick in, margins are continuing to improve, and deployments are becoming more efficient. So investors wanted to see a path to profitability, and Symbotic is showing it very quickly. So as we see, the cash position is now above 1.2 billion in cash, which is adding more than 450 million in one quarter. This huge cash balance means that they have zero financing stress, room to expand aggressively, the ability to weather macro slowdowns. If the entire economy slows down, they still have a lot of time, especially with this cash runway and the backlog that we've seen. And they have no need to dilute shareholders, which is crucial for people like me or you who are just retail investing in stocks, because we don't want to get diluted. That's the worst thing that happens in the stock market, and I think the stock doesn't really need to see that in this year, next year. So as they continue to expand into new verticals, as we've seen here, the new Medline in the healthcare vertical, this is going to be bullish because these are massive markets that are untapped potential. These need high accuracy and high efficiency, which is something that Symbotic can provide for every company on the market. So early success increases credibility, and proving their platform works beyond retail and groceries will be crucial for the stock's growth, in my opinion. And once they're able to grow into many different markets, the stock will grow in tenfold. So as we've seen, their outlook for the next quarter, the next fiscal quarter, is 610 to 630 million in revenue. This signals a lot of confidence in continued growth momentum. When management guides high and delivers, Wall Street will reward it, which is why I think this stock will reach all-time highs again in the next year. And I think this system, if we're just talking about it from a technological standpoint, Symbotics has a moat. They have tech, speed, and precision. Their systems are faster, more modular, more cost-efficient. They're fully autonomous, and they're backed by AI. Retailers don't just switch automation vendors. Once you build a warehouse around Symbotic, you're basically locked into Symbotic for years. This gives them a real competitive moat, which equals long-term premium multiples inside the stock market. And as we've seen, it's kind of translated already, but the stock is still down from all-time highs, despite this continued growth, which is something I'm watching. So obviously, as we've seen, the trend in the market has been AI, which I think is crucial. Another thing, excuse me, but as there's continued labor shortages, rising wages, supply chain disruptions, and e-commerce growth, and this all points in one direction. Automation is becoming mandatory for companies. It's not an optional thing. It's not like automation would help our company, but we don't really need it. Every company is needing this type of technology, and they're positioned as the market leader in automated warehouse robotics in a market that is expected to grow for the next 10 to 20 years steadily and continuously. So I think in the long term, this looks like a good company to be investing in, especially with their $22 billion backlog, strong revenue growth, improving profitability, the huge cash balance we've seen, the tech advantages, as I just mentioned, and AI tailwinds. I think everything's just shifting towards AI, which is going to be crucial as they continue to enter new high value verticals. I think the stock will perform very well. And the earnings call should be starting here in just about 4 minutes. So I'll keep it up on here. If anyone has any questions, though, I'd love to answer them. There's not too much I can go over really yet. I'm excited. I'll go through the presentation with you guys as they're speaking. So I'll mute my mic, but I'll continue to have the presentation up and the call, of course, so that we can go through that together. And I'll give my thoughts after the call for what I'm thinking. It should be starting here any minute now. But yeah, I think it's a great long-term investment, as I was saying. And if you're investing in here, I think you're doing yourself a good service. And I mean, the stock's already getting rewarded in after hours. We're seeing it at 62.50. I think the all-time highs was in the 80s, 70s or 80s. So there's still a lot of room to grow here. There's still a lot of time. The backlog is is absolutely insane, and it's something I'm going to continue to watch. I have a couple shares, not enough, obviously. I'm not a millionaire or anything just yet, but one day, hopefully, we all will be. We're all investing in the right companies, I feel like. So this is one of the better AI companies on the market right now, and I'm excited to hear their call because they have some of the best management inside the entire market. I really like their CEO, uh, who is who's a very good. He's very well spoken. Every time I've heard what's his name, Richard Cohen, I think his name is. He's very well spoken. He has a lot of experience inside of these types of companies, um, and he's just he's a very well natured guy. So I think that's something we're gonna have to watch in the next coming months. And the call should be starting here any minute. If anyone has any questions, I'd love to answer them. But yeah, I'm very excited though for the future of this company. Presentation shows 22. Yep. Okay, let me find it. 22. Yep, you were right. See, I thought it was 22 billion. I just wasn't exactly sure. Um, yeah, it's 22 billion. I will shrink this screen as well once the call starts, the price and stuff, so that we can see the slideshow completely. Um, cash, positive free cash flow, expanding gross margins, all stuff you really want to be seeing from a company at this stage in growth. I think it's going to be crucial to watch over the next coming months. And you're right on. I think you made one of the smarter leaps I've seen on the market these last few weeks. I see a lot of people were using margin and they got burned on the stocks getting drawn down over the last couple weeks. So you made a really good play with those leaps you bought. And yeah, it should be starting here any second now. Never mind. I thought they got me with that one. I thought it was about to start, and then they started the country music again. This is better than most calls have like the Beethoven music playing, or yeah, basically like the Beethoven music. I like it, of course, in moderation, but I'd much rather prefer this type of music, and it gets me excited for more good quarters, especially with such a strong backlog. Once they can get the efficiency of getting these to scale, then the revenue will really jump. And I think that's something we're all going to have to watch in the next coming weeks. So it should be starting here any second now. Any second now.
Good day, and thank you for standing by. Welcome to the Symbotic Fourth Quarter 2025 Financial Results Conference Call. At this time, all participants are on a listen-only mode. After the speaker's presentation, there'll be a question-and-answer session. To ask a question during the session, you'll need to press star 11 on your telephone. You will then hear an automated message advising your hand is raised. To withdraw your question, please press star 11 again. Please be advised that today's conference is being recorded. I would now like to turn the conference over to your speaker for today, Charlie Anderson. Please go ahead.
Hello, welcome to Symbotic's fourth quarter and fiscal year 2025 financial results webcast. I'm Charlie Anderson, Symbotic's Vice President of Investor Relations. Some of the statements that we make today regarding our business operations and financial performance may be considered forward-looking. Such statements are based on current expectations and assumptions that are subject to a number of risks and uncertainties. Actual results could differ materially. Please refer to our Form 10-K, including the risk factors. We undertake no obligation to update any forward-looking statements. In addition, during this call, we will present both GAAP and non-GAAP financial measures. Reconciliation of GAAP to non-GAAP financial measures is included in today's earnings press release, which is distributed and available to the public through our investor relations website located at ir.symbotic.com. On today's call, we're joined by Rick Cohen, Symbotic's founder, chairman, and chief executive officer, and Izzy Martins, Symbotic's chief financial officer. These executives will discuss our fourth quarter and fiscal year 2025 results and our outlook, followed by Q&A. With that, I'll turn it over to Rick to begin. Rick?
Thank you, Charlie. Good afternoon, and thank you for joining us to review our most recent results. We made strong progress in fiscal year 2025 and finished the year with good momentum. For the full year, we increased revenue by 26% year-over-year, while delivering significant margin expansion and free cash flow generation. The cash on our balance sheet now exceeds $1.2 billion. During the fiscal year, we also expanded and upgraded our product portfolio. We added micro-fulfillment as a new category to address e-commerce and upgraded our storage structure to a proprietary next-generation design that offers leading density and rapid installation. When we marry up our innovative bot technology that can handle goods of many sizes, this new highly dense storage structure, and our proprietary software, we believe we can unlock more opportunities than ever before. This includes everything from smaller buildings to e-commerce facilities to perishable facilities where square footage is at a premium. We are seeing this play out with a growing sales pipeline as our solutions deliver space savings and installation efficiencies that result in higher value. Customers are already taking advantage of this breakthrough in installation efficiency. Notably, our largest customers opted to utilize our next-gen storage to combine what previously took two separate deployments or phases into one single phase for new sites. That means a phase one system deployment, when we enter a distribution center for the first time, we'll be able to do twice as much work versus when we began deployments for this customer previously. And the overall time to install and achieve acceptance for the same amount of case output in this example will be cut by more than half, generating significant savings, reducing disruption, and generating a larger and faster return on investment for customers. Customers are also taking advantage of the modular build qualities of our next-gen storage, with a handful of deployments that began in the fiscal fourth quarter, connecting next-gen storage to prior-gen storage at the same site. And Greenbox is moving forward with next-gen storage, signing up to utilize it at new sites near Dallas and Chicago, both of which were signed in the fiscal fourth quarter. Notably, with these sites, Greenbox coverage will extend from California to the Midwest to the Southeast. We also finished the fiscal year by signing a new customer, Medline, the largest provider of medical surgical products and supply chain solutions serving all points of care. This marks our first customer in the healthcare vertical, where we believe the case for automation is very strong, given the importance of accuracy, speed, and cost. This is also one of the largest potential new verticals available to us. It is worth noting that there are over 500 healthcare distribution centers in the U.S. alone, with a combined 76 million square feet of warehouse space, according to the Health Industry Distributors Association. With our scale rapidly improving project execution and growing set of capabilities across the supply chain, we are in a better place than ever to bring our new customers covering multiple verticals, geographies, and use cases. Our focus in this has never been greater. In summary, we delivered on the commitment we made at the start of the year to achieve strong top-line growth and a significant rise in operational systems, thanks to improvements in our deployment process. This also enabled us to deliver strong margin expansion. Looking ahead, our key objectives for fiscal year 2026 are: number one, harness our growing product portfolio and capabilities to broaden our opportunities with customers, particularly in e-commerce with our micro-fulfillment solution. Two, unlock higher margins by driving additional value for our customers, along with operational improvements. Three, continue to invest in our innovation engine to expand our capabilities and support future growth. I just want to end by thanking our team for their efforts, along with our customers and investors for their support. I'll now turn it over to Izzy, who will discuss our financial results and outlook. Izzy?
Thanks, Rick. Fiscal fourth quarter revenue grew 10% year-over-year to $618 million, exceeding our expectations. Year-over-year revenue growth in the quarter was driven by the expansion of the number of systems in operation, fueling higher recurring revenue along with continued progress on our paid development program. Due to higher stock-based compensation reflecting our commitment to attracting and retaining top talent and restructuring expenses primarily associated with acquisition integration activities, our net loss for the fiscal fourth quarter was $19 million versus net income of $16 million in the fourth quarter of fiscal year 2024. Adjusted EBITDA in the fiscal fourth quarter of $49 million was at the high end of our forecast due to revenue and gross margin upside, and up from $42 million in the fourth quarter of fiscal year 2024. Our backlog of $22.5 billion remained in a strong position. The increase from $22.4 billion last quarter was due to final pricing on projects started and the addition of backlog associated with Medline, offsetting revenue recognized in the quarter. In our fiscal fourth quarter, we began 10 new system deployments. As Rick highlighted, this included 2 deployments for Greenbox and 1 for Medline. We also had 6 systems go operational in the quarter, bringing our total to 48 operational systems, or nearly double the level at the end of fiscal year 2024. Importantly, for the systems that went operational for our largest customer in the fiscal fourth quarter, we observed nearly 3 months of improvement in the time between start of installation and customer acceptance compared with our historical average with this same customer. This period of deployment is the portion that is most within our control, and it is also when we recognize the highest level of revenue and profit. With the continued growth in operational systems, we saw our software revenue grow 57% year over year to $9.3 million in the fiscal fourth quarter, and operations services revenue grew 21% year over year to $26.9 million. Turning to margins in the fiscal fourth quarter, system gross margin continued its trend of significant year-over-year improvement, driven by disciplined cost management, solid project execution, and strong supply chain partnership as we roll out our next-gen structure and deliver increasing value to our customers. We expect to see additional expansion in systems gross margin. Software maintenance and support also saw substantial year-over-year gross margin gains, benefiting from continued scale and exceeding 70% for the full year. In operations services, we posted a loss as we increased investment in additional resources to support certain sites and ensure their long-term success. Operating expenses on a GAAP basis in the fiscal fourth quarter were $149 million. Adjusted operating expenses in the quarter were $87 million, up sequentially primarily due to strategic R&D investments in supporting our expanding product portfolio and cloud-based software tools. These investments are in areas where we see the greatest potential to increase value and long-term impact. We finished the quarter with cash and cash equivalents of $1.2 billion, up from $778 million in the fiscal third quarter due to the timing of cash receipts tied to project milestones and the signing of new projects. Now turning to the forecast. As I've settled into the CFO role, I want to share some context for how I think about guidance. We will continue to guide 1 quarter ahead with a focus on transparency and consistency. My approach will be to set a guidance range reflecting where we expect to land based on our best view of the deployment schedules and a balanced assessment of both risks and opportunities. With that in mind, for the first quarter of fiscal 2026, we expect revenue between $610 million to $630 million, representing year-over-year growth between 25% and 29%, and adjusted EBITDA between $49 and $53 million. I want to reiterate what we highlighted during last quarter's earnings call. That is, the introduction of our proprietary next-gen storage structure has resulted in a realignment of deployment schedules. While this has no impact on our $22.5 billion of backlog, it does have an impact on how our revenue is phased throughout the fiscal year, with the quarters in the first half of fiscal 2026 showing less pronounced sequential growth. We believe this new technology advancement, combined with the unique capability of our proprietary bots and software, is resonating with customers as they recognize our competitive differentiation and the significant value our solution creates. It also unlocks new opportunities across the supply chain, as well as the opportunity for more efficient deployments, which we expect will contribute to higher margins over time for Symbotic. With that, we now welcome your questions. Operator, please begin the Q&A.
Thank you. As a reminder, if you would like to ask a question, please press star 11 on your telephone. You'll hear an automated message advising your hand is raised. We also ask that you limit yourself to one question and one follow-up. As well, please wait for your name and company to be announced before proceeding with your question. One moment while we compile the Q&A roster.
Look at all
Our
these
first
pads.
question today will be coming from the line of Nicole DeBlase of Deutsche Bank. Your line is open.
Yeah, thanks, guys. Good afternoon. Maybe just starting with Medline, is it possible for you to provide a bit more color on the relationship, what they've committed to? And then, it seems like healthcare could be a pretty big opportunity with respect to new customers. Anything on, how aggressively the sales force is pursuing that right now?
So you broke up a little bit, but the Medline relationship is something that we worked on for about a year, maybe a little bit longer. And it was a combination of understanding what they wanted to accomplish with the hospitals and the critical care units that they deliver with, and then for them to understand how the ability of our system to handle lots and lots of items, and also the incredible accuracy with which we ship product. And then thirdly, the ability we have to sequence products, because oftentimes to hospitals, you're delivering to a specific section, to a specific floor. And so we work with them to give them a good understanding of the unique capabilities of our system. And so that's why we won the award, and they have lots of warehouses, great customer. So we're very excited about that. In terms of future growth, we've added about 5 or 6 new salespeople in the past 6 months, and so we're much more in the aggressive marketing role than we were before. Probably a year ago, we were still wanting to make sure everything was working and testing out. And as I tell the organization, you can't scale chaos. But over the last year, as we began to hit all our timelines for builds and price points for execution, and the quality of the way we measure it and some of our internal measures has more than improved by almost 300%. So we're feeling very bullish about being able to handle a much broader base of customers and to deploy systems that will work on day one.
Thanks, Rick. That's really helpful. And you kind of alluded to this, Izzy, when you were talking about the cadence of 2026. But is the expectation that you guys start to really ramp next-gen systems still kind of around the middle of the year? I think that's what was shared on the last earnings call. And does that mean we're going to have kind of stable revenue through the first half, and then the next step up kind of comes in the second half of 2026? Thank you.
Nicole, that's exactly the way we're thinking of it. As you know, we unveiled it last quarter, so we had some signings then, and this quarter signings are all about the next-gen system. So what that does is exactly what you said. You'll see a less pronounced increase in revenue in, call it the fourth, the first, and the second, and then you'll see more of an increase towards the tail end. So, Nicole, I would say you got that right. Thank you.
Perfect. Thanks. I'll pass it on.
Thank you. One moment for the next question. And our next question is coming from the line of Joe Giordano of TD Cowen. Your line is open.
Hey, thanks, guys. Yeah, on Medline, can you talk about what's contemplated there? How many sites are we talking about? What types of technology is this encompassing? Is there break pack in this? Is there room for the micro fulfillment strategy in there as well? And what was like, effectively added to the backlog from them right now?
Yeah. So, Joe, it's one site. It's a proof of concept is the way we look at it. Obviously, if we do a good job, they have a lot of warehouses. And initially, we contemplated a pretty straightforward moving case system, but we also, as we think we can upsell or extend to sell to these customers micro fulfillment, which could either be in a receiving room in a hospital for them, or very specific selection for them in a warehouse. And then BreakPack is also an opportunity for us to sell. So basically, we could sell them 3 different products. But right now, we're starting out with the first original product.
And then, do we need to I just want to make sure I understand the comments about Walmart, where like the 2 phases being incorporated into one now. Do we need to change the way we describe these things? I guess I just want to make sure we understand the definition. So if you say 10 new systems were started, can some of those new systems effectively be 2 that you would have said last time? Do we have to talk in dollar terms instead of number of sites now?
I'll turn that over to Izzy because I'll get in trouble.
I think the way you said it, you have it right in the sense of, not every system is created equal, but going forward, the size of the system is going to be slightly larger. So that's how I would think about it. But
they could be slightly larger, or we also have the ability to do some smaller systems in terms of smaller space in a warehouse. So it gives us a lot of flexibility. But what Izzy was saying is absolutely right, is that in the same amount of space that we were going to install an operation in some of our bigger sites, they can actually take down more of the warehouse because we can do more work in the same space as we did before.
Yeah, I see. Okay. Thanks, guys.
Thank you. One moment while we prepare for the next question. And our next question is coming from the line of Andrew Kaplowitz of Citigroup. Your line is open.
Close enough. How you guys doing? So systems gross margin was, I think, a high watermark, close to 22%, and that's despite all the changes you're making to your systems. And I think you had spoken about more flattish gross margin for Q4. So is Q4 a function of, ASR mix maybe being a little higher? Is it safe to say you're on a better glide path, given improved operating leverage, better execution? Any more color on whether you think your system gross margin continues to sort of just kind of go up from here?
Yeah, so let me tackle what you said in the beginning of your question. It's how I think about, call it ASR in the quarter. It's really, call it mid to high digits in terms of a percentage of total revenue in the fourth quarter. And I kind of would expect that to be about the same as we progress. I think the bigger part of your question is how you think about, okay, how do you unpack the margins? And I would say we feel really, really bullish about our system margins, not only where they are, but where we're headed. So I think if you see, the last several quarters, we have kind of a little bit of a lumpiness, but I think it's about the exit trend, where we landed in the fourth. And I would say, even though we don't guide to margins, I would expect that to be a slight uptick in the first. But I think it's more about when you think about how we're recognizing revenue in, call it, that 12 to 18-month period, given when we roll out the next generation storage system, that we expect those margins to really to be expanding in the coming quarters. That's really what's the key part. And like I said, I would reiterate, if there's one thing I would walk away from today, is the fact that we are very bullish about where our margins, not only where they are, but where they're going.
It's helpful, Izzy. And then, Rick, backlog, as you know, has been somewhat flash for Symbotic. I know your burn rates are going up, but do you think you could grow Symbotic's backlog in FY26? And/or we know you're ramping on Greenbox, ASR. Can you give us an update on whether FY26 is a big year for Symbotic new customers, Greenbox? Can you start booking backlog for ASR? Any thoughts around all that?
Yeah, so You're trying to trap me a little bit. So we don't guide to backlog, but here's how I would say, right? Given the guide we gave for the first quarter, I would expect our backlog in the first quarter to really be, no different to where we are. You do have in the 10K, call it what our banding is, but what's coming through in the next, 12 months. So I would say too soon to tell of where backlog will be. It's not something but we talk to in coming quarters. But I think you have to take two takeaways. As Rick said, we've built up our sales team. We obviously have more opportunities, and so we will continue to do that. I think it's also important to think about that backlog for us is strictly what you do from a GAAP perspective, not what we think could happen, given that most customers will do one system at a time. And then last but not least, what I'll leave you with, maybe not in the next 12 months, but soon thereafter to some extent, is to think about that we still have more than $5 billion of backlog to unlock with the mini micro fulfillment systems. So I'm not troubled about backlog at all. I think that's more about our long-term strategy. But I would say that 2026 is a solid backlog.
Appreciate the color, Izzy.
Thank you. One moment for the next question. Our next question will be coming from the line of Mark Delaney of Goldman Sachs. Your line is open.
Yes, good afternoon. Thank you very much for taking the questions. First one was on Greenbox, and now that you have a CEO of Greenbox and also given the new storage structure that you've had and some of the progress you spoke to around building out sites there, I was hoping you could speak a bit more on the progress at Greenbox in terms of finding new customers to use the Greenbox sites.
Yeah, so our first site that will come live will be Atlanta. I mean, some of these sites are still under construction. Some will be a year away. Some maybe be a little longer. But Atlanta will come alive. We have a lot of interest in Atlanta. No customers to announce yet. But we expect, hopefully, in the next 90 days, next 180 days, we'll have some announcements as to who our first customers will be. We continue to get interest. And now that we actually have facilities, we are in discussions with customers about how much space they want and when, but nothing to announce yet.
Okay. Anything in particular, Rick, you think new customers would want to see in order to get across the line?
No, I think what's happened is what we're seeing is on the real estate space, there was a downturn after COVID, and then some of the big guys have gobbled up a bunch of space. So there's a shortage of space right now. So we're very well positioned. And so we're talking to people about some would be different versions of Greenbox. Some might be just jet storage. Some might be very proactive warehouse handling services. And then we're starting to talk to a few new customers about just being a whole active 3PL. So we're in a pretty good spot because we're ahead of the market. And so we're talking to different customers about different things right now.
That's helpful. And just one more from me, if I could please, on Greenbox. Your partner SoftBank has said they're looking to raise capital more generally in order to fund some of the investments they'd like to do. So as you think about what that may or may not mean for Greenbox, any implications you can share in terms of how Greenbox is looking to have the funding and what that might mean for the pace of deployment at Greenbox? Thank you.
Yeah, so, I mean, our agreement with SoftBank is ironclad. They're there to provide the funding. So we don't have any worries about providing the funding there. And we have a lot of cash to do our part of it as well. So funding will not be a problem with Greenbox.
Thank you.
Thank you. One moment for the next question. And our next question is coming from the line of Colin Rusch of Oppenheimer. Your line is open.
Thanks so much, guys. As you get into these customer conversations in a bit more detail, can you talk a little bit about the potential for adjustments to bot design or even system design more broadly, and how we might think about the cadence of that evolution?
Yeah, so that's a great question. What's happening is that the customers are coming in now, and I'll answer your question in two ways. So what's happening is that the market is appreciating the fact that we're not selling the same system that we were 10 years ago, and a lot of our competitors have not innovated. They're just scaling. So our bots, for instance, we introduced to one of our customers what we call a stretch bot. So we can now handle a 36-inch case. We might even be able to handle two 18-inch cases. So the bots have more flexibility. We've introduced vision and LiDAR on some of our bots, so we have collision avoidance. So customers are coming in, and even some of the ones that we talked to 5 years ago who weren't ready to make a decision, they come in now and they say, my goodness, the pace of change with which you guys are doing things. So I think we're really differentiating us from the rest of the world. One of the things that we have done a lot of is we've moved to cloud-based. We're investing in AI resources, the databases, so we can do sorting and slicing and pallet building and, for instance, truck routing, I think maybe better than anybody in the world at this point. So I should avoid superlatives, but our customers say, nobody can do what you guys are doing. So it's not just building very aisle-friendly pallets, it's building super-friendly aisle pallets, but we can actually route the whole truck because of the reliability of our bots, which has made huge progress in the last 2 years in terms of we pick very, 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 very high percentage of what we say we're going to pick, and we never make a mistake picking. So for hospital supply, that's absolutely critical. But for other people, like we're starting to go live with our Southern Glacier site pretty soon, and it's liquor, and so it's both bars and restaurants, and so the ability to route trucks is really critical for them. And they're telling us other people can't do it. So we continue to make improvements both in software. Our bots are getting much more technologically both intelligent, but also better vision tools, collision avoidance, better routing. And we're also innovating on our pallet building and depalletizing to get product into the system. So it's been, I mean, the reason I do what I do is I love the innovation, and I love the fact that we have a team that can do innovation very quickly. And that's creating a big, noticeable distinction between us and the rest of the market right now.
That's incredibly helpful on our side. And then just from the human capital, and the competition for talent, we're hearing about a variety of different dynamics on that. Can you talk a little bit about your ability to attract folks and retain them, as this market really heats up in terms of, both physical AI as well as some of the software that you're talking about?
Yeah, so I mean, the reason we went public is because we had to create a compensation system that would allow us to attract people that were used to being compensated in stock. And so, we're not doing billion-dollar packages out in Palo Alto, but we're doing pretty good in the Boston market and in the East. We also have opened an office on the West Coast. We've also opened an office in Vietnam because Omni Labs, which was one of the small healthcare startups that we bought, has a lot of Vietnamese people that founded that company, and so we've opened an office in Vietnam where there's huge talent. So we're getting more than our fair share of talent and at a faster rate. And one of the things that's been interesting is as the EV space falls down some, we are getting people from the EV world that are just disillusioned with some of the things that are happening there. And basically our bot, the way we're approaching it is an electronic vehicle with LiDAR and collision avoidance. It's not passenger carrying, but we do some very complicated things. And so we're able to attract people because they like the problems that we're solving. And our comp is as good as anybody needs to be we're not going to compete with ChatGPT, but there's plenty of people that aren't going to work for them either.
Excellent. Thanks so much, guys.
Yep.
Thank you. One moment for the next question. And our next question will be coming from the line of Guy Hardwick of Barclays Capital. Your line is open.
Hi, good evening. It looks like based on the change in the RPO, that there was very strong bookings in the quarter, that $600-700 million. Izzy, could you just split that out between the Medline, new win, and pricing?
Just so we, just make it clear, Medline was something we signed in the tail end of the quarter. So Medline is not going to influence really our results in the fourth quarter. Really, Medline's about no different than how we've spoken to how we, recognize our revenue over almost really a 2-year period. So I wouldn't put a lot of, call it, credence to numbers or how we achieved our fourth quarter numbers with the announcement of a new vertical. I think the fourth quarter is about the momentum that we've created for over months on end on the installations and moving, call it 6 more sites to operational. That's really what drove it, plus the fact that, yes, we did sign 10 more new deployments. But overall, I would characterize the success of the fourth quarter based on the momentum that we've been working on for months on end.
So Medline was not in the RPO, the $22.5 billion RPO at the end of the quarter?
Yes, it is in the RPO, but it's not, and it has no significance to the revenue generated in the quarter.
Okay. So my question was more, was it material to that increase in the RPO? Because given it implies that your bookings were at $700 million, given the revenue burn in the quarter plus the change in the backlog. So that's a very significant increase compared to, say, previous quarters. So question is really the mix of that, how much of it was Medline versus the increase in pricing?
Yeah. I would say it's more about the increase in pricing, or call it how you consider, what we did years ago and how inflation has moved. So that's really the main driver in the RPO change. But yes, Medline is in there.
And just in the 10K, which you referenced, Izzy, it looks like the 12% of the backlog will be delivered over the next 12 months. That's quite a big increase. And if you go back 12 months ago in the 2024 10K, said 10%. It looks like you actually missed that 10%. You came in more like 9%, particularly if you include the ASR R&D revenue. So given what you said also about being a back-end loaded year, 12% of that backlog seems quite a big significant step up on the previous delivery, which you effectively kind of missed slightly. So what reasons should we give us confidence that you can deliver 12% of the backlog in the next 12 months?
I think it's all about what we said in our prepared remarks, given that we're seeing, call it, improvements from that start of installation to the end line. And that's what gives us the momentum that we're talking about. Yes, we do have ASR that we built in during the year, so you're absolutely correct. But I think we're laser focused on the exit trends and what the new structure delivers. As you know, it's not only is it more dense, but more importantly, from an installation perspective, is that it has, call it, it's somewhat sub-assemblies that come in that have that process get done in a much faster pace. So good call out on the 10 to 12, but I'm really comfortable with the 12% that we have in this year's banding.
Thank you.
Thank you. One moment for the next question. And our next question is coming from the line of Derek Soderberg of Cantor Fitzgerald. Your line is open.
Yeah, thanks for taking my questions. On the recurring software fees, I'm wondering if you can share what new customers are signing up for in terms of an annual software fee on a percentage basis. Can you share that at all?
Unfortunately, that's not an area that we give any more color. I think it's just, in general, how you map, call it, what we move to operational and when we start triggering that software fee. But I would think if you take a little bit of the exit trend, that's really what we would be expecting in the near term.
Okay, got it. And then, Rick, you mentioned there's about 76 million square feet of distribution centers in the healthcare vertical. I'm wondering if you've done the math internally, how many modules does this equate to, or what's sort of the dollar opportunity? Just wondering if you can help us size that healthcare vertical in the U.S. Thanks.
I haven't done that, but you can ask Izzy after this call's over.
It'd be quite large.
Sounds good. We'll do.
Thank you. One moment. And our next question will be coming from the line of Jim Riccitelli of Needham & Company. Your line is open.
Thanks. Evening. I think late in the quarter, there was an announcement regarding Symbotic working with I guess a small battery technology company, I think in the UK, Nyobolt. And I'm trying to understand the significance of this, and if you could talk to how we might think of potential deployments. Is this going to be on new projects? Is there a plan to move forward with retrofits as the maintenance schedules dictate?
Yep. So all our new batteries, starting, I think, from February on, will have Nyobolt batteries. So we, for the last 15 years, have used ultracapacitors. And an ultracapacitor can take 1 million charges, but the charge only lasts about 8 minutes. The Nyobolt is actually a battery, but it charges the same way as an ultracap, and it can take a 40-minute charge. Now, that may not seem that much to you at home, but the American grid, especially with all the stuff that's happening with AI, is pretty erratic, especially in hot weather places like Florida and Texas, which also had tornadoes. So the ability to go 40 minutes is like a lifetime for us in terms of reliability of the bots. So when there's a power flicker, we want our bots to get back to a home station, which is on a charge plate. And in the past, sometimes 8 minutes wasn't enough. So this is just one more thing that as we show new customers what we're doing with battery technology, most people are operating their bots with a third rail. It's kind of an electronic wires in the system, and so when you have a flicker, the whole thing is down. But so the progress we've made on battery technology, and we've taken a stake in this company, it's very, very exciting, and we can actually use these batteries for other parts of our system, and sometimes actually to help our customers keep uninterruptible power supplies in their warehouses. So it's just one more thing of the march of technology that we had a problem. The American grid is pretty bad, erratic, and so we were thinking, well, how do we solve this problem for these automation systems? So I think this is really going to help us in life sciences and a bunch of other areas. But just in general, our systems are way more reliable than they were even 2 years ago.
Thank you. Follow-up question, just as we think about your fiscal 26 goals, I'm wondering, how does geographic expansion figure into that? Obviously, you've got a site in Mexico that you're working on, and I'm just wondering if there's an opportunity, you think, in fiscal 26 to perhaps get into Europe.
Yeah, as a matter of fact, half our sales team is in Europe today. So it's been interesting with Europe because so many of the great automation companies came from Europe, because Europe had either smaller land spaces, more restrictive labor laws. But as we go to Europe, especially with our smaller, denser warehouses, people are really getting interested. And we've been doing this long enough that the reliability issues are not a problem. So I'm very optimistic about Europe. We see lots of opportunities.
Thank you.
Thank you. One moment for the next question. And our next question will be coming from the line of Ken Newman of KeyBanc Capital Markets. Your line is open.
Hey, thanks. Good evening, guys. Thanks for squeezing me in. Izzy, I wanted to go back to your comment about the change in the phasing of the revenue. I know you said you expect less pronounced sequential revenue growth in the first half versus the back half. Just looking historically, though, I think in the last 3 years, sales have typically been down sequentially, high single to low double digits, 4Q to 1Q. And the midpoint of the guide is assuming something that's a little bit better than flat. So I just want to make sure we're understanding that growth comment for accelerating growth in the back half versus what already seems like a bit of a stronger start versus typical seasonality.
That's fair. If you take the high end of the range we just gave for the first quarter, we would sort of break the trends that we've been typically seeing, at least from what I saw the last 2 years. So clearly that's our main focus. But if you take, call it, the bottom end of the range I gave you, and that's really just, about 1% less than where we landed in the fourth quarter. So it depends. But if you take the midpoint, we're kind of flat to exactly what we achieved in the fourth quarter. But internally, as you can imagine, we're trying to get past this lumpiness and really be continuing on continual improvement. And so although I guided, right in between, guided slightly under where we are in the fourth, so the guide was 610 to 630. But if you take that midpoint, that's really where I go about this, less pronounced sequential improvement. But the overall goal, to be clear, is not to have that lumpiness in the first quarter going forward.
Okay. No, that's very helpful, color. I appreciate that. And then, and secondly, for my follow-up, we are hearing some more comments from hardware-related manufacturers around higher DRAM pricing and memory shortages. Rick, can you maybe just remind us how memory-intensive are the Symbot deployments? And just any comments on what you're seeing broadly from chip availability and pricing as it relates to your ability to kind of keep margins stable, even though I'm sure you're able to pass through the pricing. Is there a risk of, just nominally margins kind of stepping down?
No, not for us. I mean, our bots basically what our bots are doing is transmitting data back to us, which we then process in the cloud and with different various algorithms, which are mostly proprietary. So, yeah, we're buying more cloud storage, but not significantly like the super big guys are. And so, and it's coming down in price, but we're not doing that directly on the bots. What we're doing is we will take the information that the bots transmit back. That's a controllable expense, though it's going up. And then reprogram the bots for different various edge case behaviors. So like a bot will see something and say, I don't know what to do. And so it'll transmit back to us. But the bots are being trained, but the bots are not truly independent AI machines. We kind of take that information back, do the processing, run the algorithms, and then send it back out in a software release. So chips are not really a problem for us as we get bigger and better. I think this time next year we'll have over 20,000 bots. So we're a major factor for some of the medium and smaller size companies. And even NVIDIA, there's a certain amount of the lower priced chips are what we're using. We may upgrade some of those chips, but they're not the $25,000 chips that other people are buying. And we don't use that many of them.
That's super helpful. I appreciate that.
Yep.
Thank you. One moment for the next question. And our next question will be coming from the line of Mike Latimore of Northland Capital Markets. Your line is open.
Great. Yeah, I guess I'll just build off that last answer. I guess if you're expecting, 20,000 or so bots in a year, can you give us kind of a baseline of where we are now?
Yeah. I mean, we have about 15,000 bots right now.
Okay. Great.
So we expect to keep growing, and there'll be different kind of bots that we'll use. There'll be different versions. The Backus Store Mini system will use a similar bot. So there'll be different versions of our bots as well.
Yeah, that makes sense. And then I guess just on the new system starts in the quarter, I think you said there was 10. Were there any break packs in there? And I think last quarter you had guided to sort of, mid-single to upper single digits. Should we still think about that as kind of the run rate for a while?
So, there's a mix of the 10 deployments we had in the fourth quarter. Yeah, there were, a couple of break packs. Sorry, and your next question was, can you repeat your latter part of your question?
Sure. Sorry. Yeah, last quarter, I think you had guided the system starts being in the kind of mid to high single digit range, and then you did 10 this quarter. So I guess any new view on the system start number?
It's something we don't typically guide to is what our, call it system starts are going to be, or which ones are going to be moving into operational. I think the best way to think of it is although I said historically I want to get away from the lumpiness in the revenue, I do think, though, sometimes we do have more of a tail end of those deployments in the fourth quarter. Now, we have a healthy amount that we have throughout all the quarters of next year, but I think it's less about trying to manage what they are and more about, okay, the size and how much is going to be coming through in the revenue. So more importantly is the guide of the 610 to 630 in the top.
Yeah. Okay. Great. Thank you.
Thank you. One moment for the next question. Our next question will be coming from the line of Greg Palm of Craig-Hallum. Your line is open.
Yeah, thanks. I want to go back to systems gross margin because that was certainly a highlight, and it sounds like you're pretty confident that can continue to improve. So any way to maybe, Izzy, if you can sort of break out or bucket out some of the positive impacts in the quarter and just sort of broadly, what's happening, from an improvement standpoint relative to maybe the last, 12 or 18 months?
Yeah, I mean, I think we keep going back to the same thing, but I think we've actually seen it over multiple quarters. And really the way I would think about it is, we saw a little bit of, call it a decline in our operation services, but yet overall we had a terrific gross margin on the bottom line. So if you just, if you go through all the math in our earnings release, and I know it's not the easiest thing to track to, you'll come back to that the systems is really where the powerful improvement is. I think if you unpack the quarters, really what it comes down to, last year at this time, we did have some cost creep. And I think if you walk the halls here in Wilmington, what everybody reminds me of is that we did have that really disciplined cost management for the entire year. And with no cost creep in how the supply chain team installed the systems, that's really what's driving the overall systems gross margin. And not to mention what it will become as we, deploy the more denser systems. So even before that, I think that's really what's the highlight, not only in the quarter and the highlight of what we feel bullish about what the systems margins will be going forward.
Okay. Yeah, makes sense. And I guess, Rick, I'm fairly certain that Medline was a pretty large user of another competitor in the warehouse automation space. So I'm curious, does this have potential to be a competitive displacement, something that could be expanded, from this initial site? I know they've already automated a big chunk of their footprint already, so just want to hear what the actual opportunity with them could be over the years.
The answer is yes. Our technology does things that other people's technology doesn't do. We also can augment some of the other technologies that we've seen in some of their facilities, but we would do bigger projects. And I think if they like what we're doing, and I don't want to mislead anybody, we don't have a contract for any more than one, but if they like what we're doing, I think we have a huge opportunity with them.
Okay, fair enough. Appreciate the color.
Yeah.
Thank you. And our next question will be coming from the line of Keith Housum of Northcoast Research. Your line is open.
Good afternoon. Hey, Rick, I know it's kind of new news here, but the largest retailer in the U.S. Is scaling back some of their investments with, I guess, a smaller competitor of yours. I guess any thoughts on what was perhaps driving that, and does that dampen any of the enthusiasm that you see from your customers about the use of this type of technology for the fulfillment centers going forward?
Yeah, no, actually, it's actually supercharged the interest in our technology. So what's happening in the e-commerce space and in the supermarket space in particular is the congestion from all the people picking orders in the store, the DoorDash and that stuff, Instacart, was a great convenience, but it's really very confusing and messing up the stores. And so what we're talking to people about is how can you put 20 or 30,000 items in 10,000 square feet and deliver in a marketplace or a city that could be actually use the fresh produce from the store. So it's e-commerce is evolving in the way of the biggest guy in e-commerce delivers 1.2 packages or 1.2 items per delivery, but the retailers in the food space are delivering probably 15 or 20 package order, and so it actually allows them to do a lot of things that you can't do when you're just delivering 1 or 1.2 eaches. The reason I can't speak fully, I mean, I have my own view, but I won't express it here, why that retailer made a change of mind with that technology. But I think what you're starting to see and where is that we can actually use the same bot, but pick each and pick eaches or bring a tote. A bot can bring an item or a number of items to a pick station, very similar to what we do in our break pack installs, and actually do customer orders, which is initially this is what we've been trying to explain to people. 3 years ago, we did a break pack where a bot would bring a tote to a person, the person would pick it, and then we basically batch pick it. The same more or less concept can be deployed in the back of a store, except you're picking a customer order. And so the real problem that people are trying to solve with the e-commerce now is speed of delivery and much more local. So I think our commitment and our largest customer asked us to develop this for them. We're really excited. This is a very, very big market.
Great. Thank you. Appreciate it.
Thank you. And that does conclude today's Q&A session. I would now like to turn the call back over to management for closing remarks. Please go ahead.
Yeah, thank you, everybody, for joining our call tonight. We appreciate your interest in Symbotic and look forward to seeing some of you in the coming weeks at investor conferences that we'll attend. Goodbye.
Thank you all for joining.
All right, guys, that is it for the call. I want to hear your guys' thoughts in the chat real quick. If you guys enjoyed, I'd appreciate you guys if you dropped a sub, a like, and anything like that. Anything helps. I'll go over my thoughts for the quarter and what I heard on the call, some of the main things. Long story short, it's very bullish, though. The results were not just solid. They're a clear confirmation that this company is transitioning from being a high potential play into a true large scale industrial powerhouse. So if you look into the fundamentals, the story has never been stronger for the stock. And the headline number that everyone is going to be talking about, and I think you'll be hearing a lot about over the next coming days, is getting blocked by the Robinhood price right now. So let me move it over a little bit. It's this $22.5 billion backlog. This is extraordinary for a company that has only generated about 2.2 billion in revenue this year. That means that the demand for this warehouse automation systems has reached a point where customers are committing years in advance. This isn't just hype, this is locked in revenue. And this is stretching deep into the next decade. For investors, it means stability and undeniable proof that Symbotic has become the go-to provider for automated and AI-driven supply chain solutions. But for me, what makes this even more exciting is that the Symbotic didn't treat this backlog as an excuse to pull back on sales. It's someone mentioned in the chat, if they have such a big backlog, why not um, why have a sales team? Instead, they're scaling aggressively and expanding sales and deployments, which is entering new vehicles, new verticals, and strengthening relationships with major retail and distribution partners. Many people assume that the 22 billion already sold, a sales team becomes basically unnecessary. But in reality, the opposite is true because backlog is the result of phase one. The sales team is what drives phase two for the company, and expanding into healthcare, pharmaceuticals, industrial, and international markets is going to create the next 20 billion of backlog, which is it can't really sell itself. Obviously, it's a company we as investors know about it, but if you're a general company, it's hard to find these, and you need these salespeople out on the floors constantly pushing. Especially, he said over half of them are in the Europe market, which I think is where the next big expansion will happen. So that was very exciting to hear on the call. The revenue growth came in very strong as well, 26% year over year, which is proving that even in a high rate environment, the companies are still racing to automate. The demand for warehouse robotics is no longer cyclical. It's a structural trend that is driven by many different factors. We see online demand, the need for speed and precision in the market, and labor shortages. So Symbiotic is benefit from a multi-trillion-dollar shift in global logistics, and its technology continues to separate itself from its competition. So as we've seen, this is shown by its profitability continues to move in the right direction. It delivered. It does it have it here? 140. I already remember. See, adjusted EBITDA of 147 million in this quarter, and it came in at 49 million, which is showing real scaling. The deployments are getting more efficient, margins are improving day by day, and the benefits of a reoccurring service model are starting to appear, which is crucial to watch in the next coming quarters. So they also ended the quarter with 1.2 billion in cash, which gives them a lot of firepower over the next couple months to create more developments, invest in R&D, and weather any macro stuff without having to dilute shareholders, which is one of the most bullish things. Also, we saw the Medline report, which is something that kind of like they asked a couple questions about. I wish we got more clearance on it, but this is absolutely huge because healthcare supply chains demand a lot of accuracy. As you guys know, if you've ever been to a doctor's, I mean, of course, you need high accuracy, you need sterility, and high uptime, which is something that automation is desperately needed in, and it's not only adaptable, but it's desirable across completely different industries. So this is the early stage for me, in my opinion, of a multi-vertical expansion that dramatically increases their total addressable market and causes the share price to increase drastically. As we could see, the stock is already trading at 63. It's up huge over after hours. But looking forward with this guidance they also provided with the 610 to 630 million, this is basically giving us a cautious estimate, and it's very confident though as well because it signals that the company knows demand is durable and that scaling is accelerating quarter after quarter. So when you put this all together, it is clear for me to see that this company is going to continue to grow in the next coming months. And I think it's already clear to see with this stock price we're watching right now, almost at $64. I think we might be able to see another rally tomorrow before we see the holidays. Um, that will be a nice way to spend the holidays talking to the family about your investment in Symbotic. But if they continue executing at this level, with landing new verticals, expanding internationally, improving margins, and burning down the backlog without losing momentum, this stock could easily go a lot higher over the next couple years. And it's very much so a scale story and an infrastructure story. So this company is very cash rich, backlog rich, and it has a lot of growth in the future, which with a decade of revenue visibility, which is going to be crucial to watch. So I think this was one of the strongest quarters, and it's one of the strongest forward-looking setups in the entire automation and robotics sector, which I think this call reaffirmed for us, and it kind of confirmed everything we were thinking. And I thought it was a very good call. I'd love to hear you guys' thoughts if you guys have any questions or anything. But other than that, I might call it here soon. I appreciate you guys all for coming out. I hope you guys have a great holidays with your families. I don't know if not everyone celebrates it, but if you do celebrate, I hope you enjoy it. If not, then just make sure you rest up. You can take a couple days away from the market, which is always going to be nice. Not have to stress about it. Hopefully the Medline proof of concept goes well. It looks super bullish. I agree completely. I think that's going to be one of the main things we're going to watch next year. All these new verticals opening up is going to be it's something that we can't even like. I can't, it's hard, makes me hard to fathom even like how many different avenues this can go down and how much this can really change the world. So that's something we're going to have to watch, and I think it's going to be crucial. I mean, the amount of hospitals there are, the amount of healthcare physicians there are. I mean, it goes through everything. I mean, there's infinite possibilities here, and it's just a matter of how the company executes. But this was a good day to report earnings. Oh, I agree, man. It was one of the best days. My portfolio was looking like the Titanic, and like I think like I unhit the iceberg today. Or like if you guys ever played, I've been playing a game recently. It's called Sea of Thieves, and like you can repair your boat on there. So like they repaired the boat really quick, got the water off, and they reported it. Perfect day. I think we'll see more momentum into the next day. Let me get a chart up here. Let me see where the resistance lies, and then I'll leave you guys with that. And I hope you guys are doing all well, and that the call wasn't too glitchy. I didn't check the audio, which is probably my bad. It could have been horrible, and I would just have no clue. So here we have the chart for Symbotic. As we can see, it's already broken past this big gap of resistance we had here. This blue line is where it's at right now. So it broke past that. I think the next resistance stands right above this accumulation line where it was earlier at that $65 mark. So once it breaks through here, tomorrow we could see a continue to push. And then obviously the all-time high was at this $84 mark. So I mean, anything's possible. If we see any more catalysts, any more news coming out, he did mention, the CEO mentioned that they're going to announce a partnership deal in the next coming months with something that they've been doing. I forget, it was something with Walmart and in that market, the retail market. So it's something we're going to have to continue to watch. There's really no downward pressure, and we kind of bottom out here at that $50 mark. So if anyone was buying over the last couple weeks, congratulations, you've made a great play here. And that person who was talking about buying the leaps, you have done great today. I mean, that's all I'll really say. But I hope you guys have a great rest of your day. If there's no more questions, I'll head out. But I'll give it one more minute, just to check if anyone has any questions. I don't want to waste your guys' time though, and just look at charts and stuff, because I got to do that on my own time anyways. But yeah, I appreciate you guys all coming out. It was a great call, as we all heard. A lot to look forward to for this company, and I'm very bullish for the future. I want to increase how many shares I have. There's so many different stocks I've been buying, and there's been so many good deals on the market over the last couple months that it's been hard to get a position in each of them. But I'm definitely gonna try to expand it here and continue to grow the position here, because I truly do believe that this is going to be the future. And in the next decade, it will be one of the faster growing companies of the next decade, which is all run, especially with, we see this great management, we see the robust balance sheet and all this different stuff. You should add SoFi to your coverage. Believe it or not, I did have SoFi in my coverage, and I held shares of SoFi for probably about 3 years. I bought them at like $4 a share, and then I was holding them for so long, and I sold them for like not even a big gain. I could find it here. I didn't even sell them for a lot. And then, of course, as soon as I sold my shares, um, the stock went crazy. Not even crazy. It wasn't doing anything, for a long time. I feel like SoFi. Where is it? Let me find. Yep, I sold. Oh, to the channel. Of course, yeah. I gotta get it into the channel. But I sold SoFi for 1740. What's it at now? SoFi. I know it's higher. It's at 27. I mean, actually, I didn't make that bad off on that. That's not a bad trade. I sold that at like the start of the year. Can gain a lot of SoFi army is strong. Are you a part of the SoFi army, my boy? I've made one video on it and it didn't even do great. Because I do like the stock. I do think it's one of the better stocks on the market. I just thought there was a lot of other better opportunities on the market, and that's kind of where I've been at. Uh, and bro, selling puts and buying calls the last few days and been holding since 2022. Holy shit. You're no kidding. Yeah, I was holding shares since 2022, but I was not buying calls and stuff. I'll tell you that. Like at the start of this year, I sold out at like in January when it was at like 17 for a couple days, and I was like, oh, it's not, no way it's gonna go higher, and it pulled back for a little bit, but now it's at all time highs again. So I'll have to keep my eye on it for sure. That's one thing I'll put into my notes for a stock video to put out in the near future. Um, but yeah, I appreciate you being here, Drip Calc. Um, and yeah, that's pretty much it, I guess, right? Everyone, have a great rest of your day. Be safe. Be kind to one another. What else can I say that's pretty smart? Invest in good companies and watch the earnings calls. That's all that matters. But